I think it's mostly cyclical, um, with the causes both from the North Atlantic financial crisis, which has had a global economic impact, so that the whole world is slowed down. In addition, I think that there are some issues in India which do need to be addressed, which have had the impact of slowing the economy down for the time being. We probably did an excessive fiscal stimulus and a monetary stimulus in 2008-9, and then we didn't wind them back as fast as we should have. That's now being done over the past year to year and a half, and we need to speed that up so that we come back to more sustainable fiscal deficit. The higher fiscal deficit that we've had for the last 3 or 4 years has had the impact of, one, higher inflation, and two, also crowding out the private sector from resources that they could have had the government not been borrowing as much as it has been the last 3 or 4 years. And if you can get that going over the next year, 2 years, I think that it is quite feasible for the Indian economy to come back on track. The way to look at the tapering is, one, the good news, which is the tapering would not take place, and normalization in monetary policy would not take place unless the American economy starts recovering. On the other hand, given that most economies are much more open now, including India's, that the unconventional monetary policy and QE put excessive liquidity around the world, which did have the impact of inducing much more external borrowing than should have taken place in many of the emerging market economies. And therefore, the opposite, which must take place, the monetary policy has to be normalized in the advanced economies, will have the impact of global interest rates, real interest rates going up in the medium term. And once the North Atlantic financial crisis hit, central banks, particularly US Federal Reserve and Bank of England, had to do a number of unconventional things. So I think what we've learned from this is that the central banks have to be very vigilant all the time and not get seduced into what you might call narrow central banking. And as US Federal Reserve has shown, the Bank of England has shown that even when they're down to a zero interest rate, there's still other instruments that they have. So I think that for the emerging markets, the lesson is that they themselves have been using a number of different instruments, including capital account management, capital flow management, foreign exchange intervention, interest rate policies. Well, I think it will keep evolving. There's a great deal of thought in terms of changes in monetary policy making. There's a huge response from the global financial community through the Financial Stability Board, the FSB, the BIS, the IMF, in terms of greater cooperation among financial regulators globally. I think we still need to learn much more about international monetary coordination, and not enough has happened on that.